Imagine opening your mailbox later this week and finding a notice from the IRS stating that you owe an additional $22,000 in taxes. You stare at the paper, your hands trembling, trying to understand how this could possibly be true. You are retired. You are on a fixed income. You haven't gone back to work, you haven't won the lottery, and you certainly haven't done anything illegal. Yet the government is demanding a sum of money that could wipe out your emergency savings or force you to sell your car. This is not a clerical error. This is the devastating result of a forced withdrawal from your retirement account, triggering a tax bomb on your Social Security benefits. The IRS does not send you a warning before this happens. The Social Security Administration does not call you to warn you that your benefits are about to be slashed by taxation. They simply take the money, and you are left to pick up the pieces. This specific financial catastrophe is happening to thousands of retirees every single year, often because of a single misunderstood deadline, April 1st. If you turned 73 in the last year, or if you are approaching that age, you are standing on a financial landmine. Here at Senior Security Benefits, we have spent years analyzing the intersection of tax law and retirement benefits, and we see people walk into tax offices every April confused, angry, and suddenly broke because nobody told them that pulling their own money out of their IRA would set off a chain reaction that destroys the value of their Social Security check. To understand why this happens, we have to look at the concept of the Required Minimum Distribution, or RMD. For decades, you did exactly what the financial gurus and the government told you to do. You saved money in a traditional IRA or a 401k. The deal was simple. You put pre-tax money in, and it grew tax-deferred. The government agreed to wait to collect their share of the taxes until you retired. It sounds like a fair deal, but there is a catch. The government is not patient forever. Eventually, the Internal Revenue Service wants its cut. Under current law, starting at age 73, the government mandates that you must start withdrawing a specific percentage of your retirement savings every single year, whether you need the money for living expenses or not. This is the RMD. It is not a suggestion, it is a federal requirement. If you fail to take this money out by the deadline, the penalty is severe, an excise tax of 25% of the amount you were supposed to withdraw. That is a massive penalty, far higher than almost any other consumer fine. But here is the secret that financial advisors often miss. The penalty isn't even the worst part. The worst part is what happens when you do follow the rules and take the money out. When you take that distribution, it is treated as ordinary income. It gets added to your tax return just like wages from a job. And this is where the tax torpedo hits. The United States Tax Code has a specific, somewhat hidden formula used to determine how much of your Social Security benefits are subject to federal income tax. It relies on a number called provisional income. Most people have never heard of provisional income. It does not appear on your standard 1040 tax form as a line item you fill out easily. It is a calculation that happens in the background, and it controls your financial destiny. The formula is your adjusted gross income, which includes your pension, wages, and those IRA withdrawals, plus any tax-exempt interest, like from municipal bonds, plus exactly 1/2 of your Social Security benefits. If this combined number, your provisional income, crosses certain thresholds, your Social Security becomes taxable. Here is why this is a crisis right now. The thresholds for provisional income were set in 1993 and 1984, and they were never indexed for inflation. They are frozen in time. In 1993, $32,000 was a significant amount of money for a retired couple. Today, it is barely enough to cover basic living expenses in many parts of the country. Yet, the law remains unchanged. If you are single and your provisional income is between $25,000 and $34,000, up to 50% of your Social Security benefits become taxable. If you go just $1 over $34,000, up to 85% of your Social Security check is exposed to federal income tax. For married couples filing jointly, the numbers are $32,000 and $44,000. Think about how low that $32,000 threshold is. If you and your spouse act responsibly and collect a combined $2,000 a month in Social Security, that is $24,000 a year. Half of that, $12,000, counts toward the formula. You only need $20,000 of other income, from a pension or an IRA withdrawal, to cross the threshold where the government starts taxing your benefits. Let's look at a detailed case study to show you how the RMD triggers this disaster. Let's talk about a retiree we will call Gloria. Gloria is a 74-year-old retired schoolteacher living in Sacramento. She was diligent her whole life. She has a modest pension, a healthy Social Security check, and a nice nest egg in a traditional IRA. She turned 73 last year. The law allows you to delay your very first RMD until April 1st of the year after you turn 73. So, Gloria waited. She took her first withdrawal of $36,000 in March of this year. She thought she was safe. But when she filed her taxes, her accountant gave her the bad news. That $36,000 withdrawal was added to her pension and half her Social Security. Her provisional income skyrocketed past $54,000. This pushed her deep into the 85% tax bracket for Social Security. Suddenly, 85 cents of every dollar she received from Social Security was being taxed as ordinary income. She owed $4,200 more in federal taxes than she had budgeted for. She didn't have that cash in her checking account. So what did she have to do? She had to withdraw more money from her IRA to pay the tax bill. And guess what that does? It increases her income for next year, creating a cycle of taxation that eats away at her life savings. This brings us to the critical deadline approaching in just 16 days. If you turn 73 in 2025, your absolute final deadline to take your first RMD is April 1st, 2026. You might be tempted to wait until the last minute, or you might have forgotten entirely. If you miss it, you face that 25% penalty we mentioned. But if you take it now, without a strategy, you fall into the trap Gloria fell into. Furthermore, there is a double whammy danger here that is rarely discussed. If you delayed your 2025 RMD until April 1st, 2026, you still have to take your 2026 RMD by December 31st, 2026. That means you will have two large withdrawals hitting your tax return in a single calendar year. This will almost certainly push you into a higher tax bracket and guarantee that 85% of your Social Security is taxed. It creates an artificial spike in income that the IRS loves, but your wallet hates. The tragedy of this situation is the lack of coordination between government agencies. The Social Security Administration processes your monthly benefits. The IRS taxes those benefits. But these two massive bureaucracies do not talk to each other to help you plan. When you walk into a Social Security office to apply for benefits, the claims specialist is trained to calculate your benefit amount based on your earnings record. They are looking at your work history, your age, and your eligibility. They are absolutely not trained, nor are they allowed, to give you tax advice. They cannot look at your 401k balance and warn you, hey, in 5 years when you have to take a withdrawal, it's going to reduce the net value of this check we are giving you. They process 30 to 40 claims a day. They are trying to clear the queue, not act as financial planners. This is not malice on their part. It is a systemic failure. The system was never built to protect you at tax time. It was built to process payments and collect revenue. You are the only one who can connect the dots, and that is why we are sharing this information today. However, there is a silver lining. There is a specific strategy codified in the tax law that allows you to satisfy your RMD requirements without triggering the tax torpedo. It is the single best tool retirees have to protect their Social Security, yet so few people use it because they simply don't know it exists. It is called a Qualified Charitable Distribution, or QCD. A QCD allows you to transfer money directly from your IRA to a qualified charity. This transfer counts toward your required minimum distribution for the year. But here is the magic part. The money is excluded from your adjusted gross income. It does not show up on the line of your tax return that determines your tax bracket. Because it is not part of your AGI, it does not flow into the provisional income formula. It is as if the withdrawal never happened. The money goes to a good cause, your RMD obligation is satisfied, and your Social Security benefits remain untaxed. Let's break down exactly how this works because the details matter immensely. First, you must be at least 70 and a half years old to do a QCD. This is interesting because the RMD age is 73, but the QCD age is 70 and a half. This gap gives you a planning window. The limit for 2026 is $111,000 per person. If you are married and both of you are over 70 and a half, you can each do this, totaling over $222,000. Most people's RMDs are well under that limit. Let's go back to our math. Imagine your RMD for this year is $15,000. If you take that as a check to yourself and put it in your bank account, your income goes up by $15,000. That could push your provisional income over the $32,000 limit for a married couple, triggering taxes on your Social Security. It might also push you into a higher tax bracket for the rest of your income. However, if you instruct your IRA custodian to send that $15,000 directly to your church, your local food bank, an animal shelter, or any 501c3 charity, the money leaves your account, satisfies the government requirement, but stays off your tax return completely. Now, I know what some of you are thinking. I can't afford to give away my entire RMD. I need some of that money to live on. That is a valid concern. But here is the nuance most people miss. It doesn't have to be all or nothing. You can split the distribution. Let's say your RMD is $10,000. You really want to donate $2,000 to your synagogue this year anyway, and you need the other $8,000 for bills. You can do a $2,000 QCD to the synagogue and take the $8,000 as a regular withdrawal. That $2,000 stays out of your taxable income. Every single dollar you route through a QCD is a dollar that the IRS cannot use against your Social Security. It lowers your provisional income dollar for dollar. For many people who are right on the edge of that $25,000 or $32,000 threshold, doing a partial QCD can be the difference between paying zero tax on their Social Security and paying thousands. There is another massive financial cliff that the QCD helps you avoid, and it is called IRMA. This stands for the Income-Related Monthly Adjustment Amount. This is a surcharge that Medicare adds to your Part B and Part D premiums if your income is too high. For 2026, the threshold is roughly $103,000 for a single person and $206,000 for a married couple. If your income crosses that line by even a single dollar, literally $1, your Medicare Part B premium jumps from the standard rate of roughly $185 to nearly $260 a month. That is an extra $90 a month, or over $1,000 a year, just for crossing the line by a dollar. And just like the tax torpedo, IRMA is calculated based on your tax return from 2 years prior. So a big RMD you take in 2026 won't hit your Medicare bill until 2028. You will have forgotten all about the withdrawal by then, and suddenly you get a letter saying your Social Security check is shrinking because your Medicare premium is spiking. A QCD prevents this because it keeps your income low, keeping you safely under the IRMA cliffs. We need to walk through the exact steps of how to execute a QCD because if you do it wrong, it doesn't count. The IRS is very strict about the procedure. Step 1. You must call your IRA custodian. Whether your money is with Fidelity, Vanguard, Charles Schwab, or a local bank, you need to speak to them. Tell them specifically, I want to make a qualified charitable distribution. Do not just say, I want to make a withdrawal. Step 2. The check must be made payable to the charity, not to you. This is the most common mistake. If the investment firm cuts a check to John Smith, and you deposit it and then write a personal check to the charity, that is not a QCD. That is a taxable distribution followed by a charitable deduction, which is mathematically inferior for most people because of the standard deduction. The money must technically flow from the IRA directly to the charity. Some custodians will mail the check to your house, but it will be made out to the charity. Or example, pay to the Order of the Red Cross. You can then hand deliver it or mail it yourself, but the payee line must read the charity's name. Step 3. You must get a written receipt or acknowledgement from the charity for your tax records. Step 4. You must report it correctly on your tax return. On Form 1040, your total distribution will show up on line 4A, but on line 4B, which asks for the taxable amount, you must exclude the QCD amount. You or your tax preparer should write the letters QCD next to line 4B. If your tax preparer doesn't know what a QCD is, you need to find a new tax preparer immediately. This is basic retirement tax law, and missing it costs you money. Let's reconsider the April 1st deadline in this context. If you are one of the people who turned 73 last year and you still haven't taken your 2025 RMD, you have only days left. You are in a precarious position. You are about to face the double tax year. If you simply withdraw the cash now and then withdraw the cash again in December for your 2026 requirement, you are going to hammer your own finances. This is the perfect scenario to use the QCD strategy aggressively. Perhaps you use a QCD for the first RMD to keep your income low and take the second one as cash, or vice versa. You have options, but only if you act before April 1st. The QCD check must be processed and the funds must leave the account before the deadline. Waiting until March 31st is dangerous because banking systems can be slow. You need to be on the phone with your custodian this week. This information is not just about saving a few dollars. It is about preserving the dignity of your retirement. You worked for decades to build that nest egg. You paid into Social Security with every paycheck you ever earned. The system is rigged to claw back as much of that as possible through invisible taxes and surcharges. The tax torpedo and the Irma cliff are the tools the government uses to do this. The QCD is your shield. It is the legal, IRS-approved method to fight back, but it requires proactive behavior. The government relies on your inertia. They rely on you just accepting the default option, taking the cash and paying the tax. They profit from your lack of knowledge. Gloria, the teacher from Sacramento we mentioned earlier, didn't know about QCDs until after she had already paid that $4,000 tax bill. When she found out that she could have donated to the library she loved instead of paying the IRS, she was heartbroken. She said, "I would have rather given that money to the community than to the mechanism that is taxing my Social Security." Don't be like Gloria. Don't wait until the damage is done. If you know anyone who turned 73 recently, or anyone who is complaining about their taxes going up in retirement, you need to share this information with them. Share it with your spouse so you are both on the same page. Share it with your financial advisor and ask them, "Why haven't we discussed QCDs to lower my provisional income?" If they don't have a good answer, it might be time to look for a new advisor who specializes in retirement income planning rather than just investment growth. The clock is ticking. April 1st is 16 days away. The end of the year comes faster than you think. The machinery of the IRS is automated and relentless. It will calculate your provisional income down to the penny and tax you accordingly. But you have the power to change the inputs of that calculation. By using a qualified charitable distribution, you take control of your adjusted gross income. You decide how much of your Social Security is exposed to taxes. You protect your Medicare premiums, and you get to support the causes you care about in the process. It is a win-win for you and your community, and a loss for the IRS. That is the kind of retirement planning we believe in at Senior Security Benefits. Stay vigilant, protect your hard-earned money, and make sure you make that call to your custodian this week. Do not let the deadline pass you by. Your financial security depends on it.